So you're watching the Bitcoin charts and you're hearing the same old stories. It's the Fed, it's a new regulation, it's just a healthy correction. Forget that. That's not the real story. The headlines are completely missing the point. While everyone's distracted by the usual noise, the real danger is hiding in plain sight. Bitcoin's very structure is being tested, and we have the on chain data to prove it. In this video, I'm going to show you exactly why the system is flashing warning signs of fragility and why the real crash might be coming from a place nobody is looking. Everyone wants to blame this crash on the usual suspects: macro news, central bank policies, another DeFi exploit. And sure, those things matter. They're the spark, but they are not the real story. The market isn't just selling off because of bad news. Its ability to absorb bad news is failing. You've heard it's about the Federal Reserve or the Bank of Japan. You've heard about the huge liquidations, but that's just a tiny piece of the puzzle. Those are the symptoms, not the disease. The disease is a dangerous thinning of market liquidity. The very plumbing of the market is under serious stress. Understanding this is the single most important thing you can do to protect yourself and see what's coming. Because when the plumbing fails, it doesn't matter how solid the house looks from the outside. The truth behind this brutal drop from over $125,000 down to the mid 80,000s is a massive evaporation of market liquidity. I'm going to show you the on-chain and market data that proves the system is more fragile than it has been in years. So what is liquidity? Let's make it simple. Think of the market as a swimming pool. When the pool is deep, you can do a massive cannonball, a huge buy or sell order, and it barely makes a ripple. The price stays stable because the market absorbs the splash. But what happens when that water level drops and the Olympic pool becomes a shallow puddle? Now, even a small splash, a modest sell order, can create giant waves and expose the concrete floor. That is exactly what's happening in the Bitcoin market. The order books, which are the depth of that water, have become terrifyingly thin. Even a small wave of selling can now trigger a market-wide cascade. This isn't just a theory. We've seen it happen. In recent weeks, sharp drops have dragged Bitcoin down from its highs into the mid $80,000 in shockingly short periods, liquidating hundreds of millions in leveraged positions along the way. This is not a normal correction. This is a liquidity crisis in the making, and it changes everything about how you should be looking at risk right now. That's a big claim, I know, but the on chain data doesn't lie. This isn't FUD. This is about looking at the market's plumbing to find the leaks. We're going to look at three things: the order books, the market makers, and the terrifying power of derivatives. First, the order books. This is your most direct measure of liquidity. A list of all the buy and sell orders waiting on an exchange. Deep order books mean a thick wall of buyers ready to absorb selling. But recent analysis has shown periods of alarmingly thin liquidity. During the sharp sell offs in December 2025, market data revealed that the buy walls supporting the price had all but vanished. Spreads between the best buy price and the best sell price widened, a classic sign that liquidity is gone. This means a big seller has to smash through fewer and fewer buy orders, sending the price down way faster. One analyst noted that key support zones between $80,000 and $88,000 had almost no order book depth, which magnifies the damage when big orders hit. Instead of hitting a mattress of buy orders, sellers were hitting a trampoline. So, why did the books get so thin? That brings us to market makers. These are the firms, like Wintermute or other major trading desks that provide most of the market's liquidity. They constantly place buy and sell orders to keep things running smoothly, profiting off the tiny spread. But they aren't here to do us favors. They are risk managers. And when volatility explodes, their algorithms do one thing: pull their orders. They run for the hills to avoid getting steamrolled. There's strong commentary suggesting this exact behavior made recent crashes worse. When a major player like Wintermute reportedly rebalances and sells heavily into a volatile market, the pool of water in our analogy instantly gets shallower. That's not a long-term bearish bet. It's a self-preservation move. But it creates a liquidity void, an air pocket in the market where the price can collapse. And this is where the real danger ignites. Thanks to our third most explosive element, leverage. The crypto derivatives market is where the real action is, with trading volumes that dwarf everything else. It's a world of perpetual futures and liquidation engines. When you take a leveraged long position, you're borrowing to amplify your bet. If the price ticks against you, the exchange automatically force sells your collateral to cover the debt. That's a liquidation. Now imagine what happens when a small sell-off starts in a market where liquidity has already vanished. The price drops, and it immediately hits the liquidation points for thousands of leveraged positions. The exchange's engine becomes a forced, indiscriminate seller. It dumps collateral onto the market at any price. This massive wave of sell orders hits the already thin order book, causing the price to plummet even further, which in turn triggers the next wave of liquidations in a self-reinforcing death spiral. That's a liquidation cascade. We've seen it play out with brutal efficiency. One sharp downturn saw over $400 million in liquidations in just a few hours. Another series of events saw cascades of hundreds of millions contributing to the slide. These aren't just numbers. It's the market's leverage engine turning on itself, fueled by a lack of real liquidity. And it's not just retail. The new Bitcoin ETFs have brought a new dynamic. While they're great for long-term adoption, they also create huge concentrated flows. After massive inflows earlier in the year, Q4 2025 saw the trend reverse, with spot Bitcoin ETFs seeing huge outflows, at one point losing $1.1 billion in a single week in November. When an ETF has to sell Bitcoin to meet redemptions, they are a massive price-insensitive seller. In a thin market, those outflows hit just as hard as a liquidation cascade, piling on the pressure. So there's the evidence: thinning order books, market makers stepping back, and a hyper-leveraged derivatives market ready to pour gasoline on any fire. This is the trifecta that creates a structural crisis. This is the real crash. So what does this all actually mean for you? The implications are sobering, but understanding them gives you a massive edge. First, the risk of violent, fast-moving crashes is higher now. The market structure itself is fragile. A macro event that used to cause a 5% drop might now trigger a 15% flash crash in hours as liquidations take over. Support levels you see on a chart are meaningless if the liquidity isn't there to defend them. This makes traditional risk management, like setting a stop loss, incredibly difficult. By the time your order triggers, the price could be miles below where you wanted to get out. Second, this changes the very nature of volatility. We're not just in a bull or bear market, we are in a structurally fragile market. Expect more whipsaw prices, violent drops, followed by equally violent bounces as shorts get squeezed. only for it to fall again. These aren't healthy trends. They are the spasms of a dysfunctional, illiquid market. It's a playground for high frequency traders, but a minefield for the average investor. Third, this challenges the narrative that institutional ETFs would automatically stabilize the market. In many ways, they've concentrated the risk. Short-term institutional flows from ETF redemptions or fund rebalancing are now a primary source of volatility. We're seeing that institutions are just as prone to macro fears, and their massive coordinated moves can drain liquidity just as fast as any retail panic. But here's the crucial part. Acknowledging this isn't about being a doomsayer. It's about being a realist. Knowing the market's plumbing is stressed puts you ahead of 99% of people who are just reading headlines about the Fed. This knowledge transforms you from a passenger into a navigator. You start looking at different metrics: on-chain exchange flows, order book depth, and leverage ratios. You understand that a sudden crash isn't necessarily about Bitcoin's fundamental value, but could be a mechanical, leverage-driven event. This perspective lets you tell the difference between a real signal and all the noise. The big players are already adapting to this new reality. They're using more sophisticated hedges, avoiding heavy leverage, and likely buying during the liquidation cascades caused by others' mistakes. They know the game has changed. The only question is, will you adapt too? Navigating this new environment requires a different level of analysis. The old rules are being rewritten in real time by these hidden market forces. If you want to stay ahead of these critical shifts and get the kind of data-driven insights that separate the smart money from the crowd, make sure you subscribe to the channel and hit the notification bell. We break down this complexity every single week so you can see what's really moving the market. Let's bring it all together. We've just bypassed the surface level news and looked deep into the market's engine room. The theme is clear. The recent Bitcoin crash isn't just another dip. It's a symptom of a deeper systemic issue, a dangerous thinning of liquidity that makes the entire system vulnerable. We've seen how thin order books create air pockets where the price can free fall. We've talked about how key liquidity providers, the market makers, are designed to step away when things get volatile, making the problem worse. And we've uncovered how the terrifying leverage in the derivatives market acts as an accelerant, turning small dips into cascading liquidations. This isn't a story about the Fed or the Bank of Japan causing a sell-off. This is a story about how their policies are just a tiny spark in a room that's become filled with gasoline. The real problem is the gasoline: fragile liquidity and immense built-up leverage. So the real crash we need to watch for isn't just a price drop. It's a structural failure of liquidity right when it's needed most. The game has changed. The risks are more mechanical, more sudden, and more violent. But they are also more understandable if you know where to look. While painful, these deleveraging cycles can purge excess risk and lay the foundation for a healthier market in the long run. The ultimate question you need to ask yourself is this: when the tide of liquidity truly goes out, will you be caught swimming naked, or will you have seen the warning signs and already be standing on high ground?